One of the biggest risks facing China's recovery is a possibility of foreign outflows in the second half of this year. That's according to the former PBOC official, David Li Daokui, that is, who told us on Tuesday that a reversal in capital inflows and a possible wave of bond defaults are two of the biggest threats to the economy. Joining us now to discuss all of this is Milken Institute Chief Economist Bill Lee. So, Bill, as much as we talk about the kind of Chinese ecosystem being very much isolated and decision-making being top-down, do you see the risk of monetary policy and the economic recovery and, machinations in treasury markets having an effect in China?
Well, the huge draw out of China is going to come from the United States because the United States economy is coming back online. There's a huge amount of spending that's about to take place, a lot of profits to be made with companies here in the United States. Whereas in China, we see from the fact that the Chinese stock market really has dropped for the year as a whole, it belies the fact that the Chinese recovery is really so powerful. We know the supply side is very powerful because we see the exports of China coming into the United States all the time. We're buying laptops and medical supplies. But the demand side is really questionable, especially the private demand. Public demand, infrastructure spending and government spending has been propping up the demand side. But we see that during Chinese New Year's, the restrictions on travel and other private sector activities is really taking the Chinese economy back a bit. So that taken together means that Chinese investors want to go where the profits are. And clearly, as the U.S. comes back online, it's going to be in the United States. Also, the regulatory scrutiny that the Chinese authorities have put on the most innovative companies in China, the fintech companies and the internet companies, that's also put into question the powerhouses of China actually becoming profit centers.
Oh, that was actually going to be my next question, Bill, because as we look ahead to quarterly earnings out of Tencent, that is the big question. What are the big, the next big growth drivers if these fintech e-commerce tech giants are going to be curtailed?
That's the scary part, because here in the United States, we know that the Amazons and the web services are the big powerhouses behind the profitability in the service sector of the U.S. economy. And the technological innovations that come up from that has been driving productivity gains in all the economy, especially in the service sectors. In China, we would see that Alibaba and Tencent should be that same source of innovative impetus to drive the Chinese economy. But if you try to restrict the degree of innovation from a top-down approach, which Chairman Xi has said, was something he desired, even going back to his speech in Shenzhen, where he said that the innovations have to be controlled and directed toward the needs of the center. That kind of directed innovation is something that has never worked in any economy and threatens to really kill the goose that laid the golden egg that has driven the Chinese economy so successfully so far.
Bill, talking about the innovation and technological advances, how much does that add to the secular deflationary forces out there? Because, for example, we saw the recovery in China that didn't really bring that much inflation. We're talking about negative CPI in the 3 of the past 4 months. Here in the U.S., we're worried so much about overheating.
I am so glad you asked that question, because the world has been engaged in disinflationary forces for the last 10 years. A lot of disinflation comes from the globalization of goods production that has gone to China and all of Asia, because that's where the highest productivity has been. But the new service sector productivity gains are going to come about from the software companies like Snowflake and Palantir that are going to innovate the way the services are able to do business. And also with the COVID disruptions, all services in the United States are going to come back online much leaner and much hungrier and much more capable of lowering costs. What you see in China is the need to do a similar thing, but the lack of innovation that comes about because you tie down these innovative internet firms is going to be a real problem. And the degree of service sector deflation is going to be much more severe in the United States than it would be in China, where you don't have these productivity gains.
And of course, all of this debate happening because we have so much monetary stimulus, but also fiscal spending. Take a listen to what Secretary Yellen had to say about how you're going to pay for all of that.
A longer-term plan that addresses critical needs of this economy probably would be accompanied by some revenue raisers.
When should we start asking about the sustainability of deficits and debt?
Well, they're already asking the question that Shery Ahn said, if we're going to be putting in long-term spending programs that are beyond the one-time stimulus package of the sort that we just saw in the $2 trillion stimulus package, the infrastructure plans are going to be long-term spending of about $3 trillion over the next 10 years. Now, that in and of itself isn't all that much because it's only $300 billion a year. But what we need to worry about is how to finance that. Now, if it's truly infrastructure, it can easily be financed with public-private partnerships. The government doesn't have to issue bonds. It could try to guarantee the debt of highway authorities, airport authorities. But instead, what worries most of us economists is that they're putting in place a lot of entitlement programs that are beyond infrastructure, and that will have to be financed with government debt. And how to do that is going to be inviting the bond market vigilantes to come in and raise interest rates. So that means taxes are the only way to go. And that in itself would dampen demand. So the people who are so afraid of the excess aggregate demand that comes on the U.S. economy and driving growth beyond 6% over the next 2-3 years have to keep in mind that there are going to be a lot of taxes put in place, and that's going to dampen demand in and of itself.
Bill, we're just looking at Bloomberg analysis data that we've crunched, looking at the trade purchases target from the US-China trade deal, and it looks like China is well behind. It's purchased only about a third of what it said it would under that 2-year deal. Does this, as well as, I guess, structural changes in global economies post-COVID, suggest that maybe global trade is a smaller share of global growth after the pandemic?
Oh, no. In fact, I think the global trade is going to be a much larger share of growth, but it's not going to be the sort of globalization we saw before, where it's simply going to the place where you have the least cost production. It's going to be regionalization, and the need for national security. I think Secretary Blinken has made it clear the United States will stand behind the treaties of its allies in Asia Pacific. And if China wants to integrate into Asia Pacific, it's going to have to do that given our alliances. So that means that as China sort of goes away from its inward-looking dual circulation strategy and tries to integrate it to the rest of the world, it will have to develop trade on a much more bilateral and regional basis, just as the United States will be developing more regional ties with Europe and also Latin America and the North American Trade Pact.
One area of geopolitical tensions has been tech, of course, and today Fed Chair was asked about the risks surrounding a potential digital dollar, as of course you have China working on their own digital currency. As an economist, is that something that you factor in when looking to the future, about the future of the global economy?
That's one of the sources of efficiency gains in the financial sector that all economists are looking forward to. The real question is, how do you regulate that in a way that prevents the kind of untoward behavior like sort of the black market and illegal activities, and be able to maintain transparency over transactions. And that's what the BIS was discussing with all the central banks, is how to develop a digital currency that has transparency, accountability, and is usable as a medium of exchange, but at the same time allows some degree of privacy so that people can have transactions without being monitored by Big Brother. And that's a very fine line to tread.
Bill, always great having your thoughts. Do join us again soon. Bill Lee, Milken Institute chief economist there. Coming up next, GameStop shares taking a tumble in late trade after reporting a profit.